Things were a lot different in the 1970s when Edgar Winter took everybody on a free ride. But one thing that's remained the same in the mortgage business, everybody's always looking to get the lowest rate and the lowest cost. So it comes as no surprise that we often get asked about the very enticing no-cost refinance. And as you might suspect in the financial world, there's never a free ride. Despite this, let's cover the concept of a no-cost refinance, talk about how it works from a technical perspective, and help you determine if it's the right fit for you. Hey guys, welcome to Rockin' Real Estate. I'm Rob Spinoza with Guaranteed Rate. If you're a home buyer, a homeowner, or even a real estate professional looking for home finance tips, tricks, and the occasional cool guitar licks, I've got your backstage pass to a better understanding of the mortgage business. In a typical refinance situation, a homeowner will strive to reduce the rate and payment as a priority. But even the most advantageous refinances will involve some cost. Not only the cost of obtaining the loan itself, lender fees, title and escrow fees, the cost of an appraisal, but also the future interest charges on the new loan. It's important to keep all of these in mind when we think about whether or not a no-cost refinance is a good fit. But in order to understand what a no-cost refinance is, we first need to understand how costs are typically paid. Let's say a refinance applicant has a $750,000 loan balance. Let's also assume that it's going to cost them $3,750 to close the refinance, their costs. They have three ways that they can cover this expense. First, the borrower can take a $750,000 new loan and pay the $3,750 out of pocket at close of escrow. Simple, financially effective, but also not that common because nobody really likes to write a check at close of escrow. Second, the borrower could take a loan of $753,750 if the loan to value permits. Let's assume it does. This borrower could then roll the closing costs into the new loan balance. Yes, he would have a slightly higher payment than if he just refinanced $750,000, even if the rate's the same, and that's because the balance is slightly higher. Third, the borrower could keep the loan amount at $750,000 and have the lender issue a lender credit to cover the closing costs. A lender can accomplish this by charging a slightly higher interest rate than the borrower could otherwise obtain if choosing either option 1 or 2. But why on earth would anyone choose to get a higher rate? Okay, here's the concept you must grasp in order to understand how a no-cost refinance works. When a lender looks at his rate sheet on any given day, he'll have a range of rates available. Let's say that range goes from 2% to 4% in increments of 1/8%. Now on this rate sheet, each rate will also have a price associated with it. Lower rates provide less revenue to the lender, and higher rates provide more revenue. Here's where it gets tricky. Lenders are regulated to meet a target revenue percentage on each loan. This is determined in advance, it can't change per client, and varies only by the loan size. So let's say a lender has a target revenue percentage of 0.5%, and we use our example loan amount of $750,000. This lender would need to earn a commission of $3,750, 0.5%. If that loan size goes to $800,000, now the lender would earn a commission of $4,000, again, 0.5%. On the lender's rate sheet, each rate will produce a price, and the first rate offered to the consumer is typically the one that meets the lender's target revenue percentage without any additional points, otherwise known as discount or discount points. Let's say 3% is yielding 0.5%, thereby meeting the lender's target revenue percentage. The lender could then offer the consumer 3% at 0 points. Now let's say that the next highest rate on the rate sheet, 3.125%, yields a price of 1% or $7,500. There would be an excess of revenue and the lender may not earn that revenue per regulations. However, the lender could return that $3,750 overage to the consumer in the form of a lender credit, thereby reducing or altogether eliminating the closing costs, a no-cost refinance. So we can see that the term no cost is a bit of a euphemism. The costs are always there, but how they get paid varies. And this matters because not everybody who refinances has exactly the same objectives. Those who are looking to get the lowest rate, the lowest payment, and pay the least amount over time, they're probably best served by paying the closing costs out of pocket, keeping the loan balance as low as possible, and securing the lowest interest rate. However, those who are intent on lowering their rate and payment beyond what they currently pay, and who have less of a concern about the cumulative interest over time, they might really benefit from a no-cost refinance. And that really pays off if rates go down in the future, because they're free to refinance again, having not spent any money to refinance the first time through. And that higher rate they took, it matters less as well because they never held the loan long term. Like with so many other aspects of mortgage financing, there's no right or wrong answer as to the best approach. It'll depend on your financial goals, your current needs, and where you see interest rates going over the time you plan to hold the loan and the home itself. But if you have any questions about any type of refinance, don't hesitate to get in touch at any of the links below or by calling us directly at 415-367-5959. And if you found today's video helpful, please click on the like and subscribe buttons below, and we'll do our best to keep the hits coming.